Imagine this. In just 1 week, investors poured more than $31 billion into US equity funds during the week ending of July 2, 2025, the biggest surge of new money in nearly 8 months. At the same time, Bank of America reported its wealthiest clients and institutional desks had gone on a 12-week buying streak, scooping up billions worth of US stocks. Companies themselves are joining the party too, with share buybacks running at the fastest pace in over a decade. Something is clearly happening beneath the surface of the US markets. For most of 2022 and 2023, institutional investors were a little cautious, even pulling money out of equities while retail traders carried the rally. But now the tide has turned. Some of the biggest names in fund management, the very players who are usually the most conservative with their capital, are back in accumulation mode. What's more interesting is where this money is going. Tech funds have seen billion-dollar inflows in a matter of days. Financial giants like Charles Schwab and KKR are attracting record institutional interest, and even defensive plays like healthcare are quietly outperforming thanks to heavy professional buying. It's not just broad market optimism, it's a deliberate large-scale reallocation that is reshaping the market leadership. And here's the key question: why now? Why are the so-called smart money investors suddenly turning bullish after sitting out for so long? What do they see in the economy, in policy, and in corporate earnings that makes them confident enough to deploy billions? That's exactly what we'll unpack in this video. The real reasons behind this surge of institutional buying is what signals it for the broader market, and most importantly, what it means for everyday investors like you. Now, coming to my first section, why are institutions buying now? What are the core drivers here? When institutions shift billions into the market, it isn't random. It's the product of macro analysis, performance pressures, and strategic positioning. The recent wave of buying reflects a convergence of powerful drivers that together have flipped sentiment from caution to confidence. The number one core driver here is the Federal Reserve and the interest rate cycle. The most immediate catalyst is the relief that the Federal Reserve has reached the end of its tightening campaign. Inflation has cooled, the labor market is showing signs of balance, and expectations of rate cuts are creeping closer. For institutions, this changes the calculus. If yields on bonds and cash are set to fall, then equities suddenly look more attractive on a relative basis. The pros know that they can't wait for the actual cut, they position ahead of it. Number 2, soft landing optimism. Recession fears that dominated 22 and 23 have kind of faded. Surveys show clearly that 2/3 of fund managers expect a soft landing, meaning the economy slows without a crash. Consumer spending remains resilient, GDP is steady, and earnings haven't collapsed. This reduces the need for defensive hedges and gives institutions a little confidence to re-risk their portfolios. Number 3, corporate earnings and the AI growth story. Now, earnings resilience, especially from mega cap tech, has forced institutions to participate. AI has created a new growth narrative around companies like Nvidia, Microsoft, and Alphabet. Add Apple's consistency and cloud giant strength, and it's hard for big funds to stay underweight. Beyond tech, financial firms, like I said earlier, Schwab and KRK are benefiting from wealth management and private market growth, while healthcare offers steady cash flows with defensive appeal. Number 4, catch-up and FOMO. Institutions were cautious through much of the last rally, letting retail investors drive gains, and the result, many professional managers underperformed. With markets hitting records, they are now in their catch-up mode, scaling into equities to close performance gaps and avoid the left behind. Fear of missing out isn't just the retail phenomenon, it also affects fund managers who are judged quarter by quarter. Number 5, shifting risk appetite. Risk-taking is no longer a taboo. Surveys show fewer institutions are de-risking and more are actively seeking now growth exposure. That doesn't mean reckless bets, but it does mean that it is tilting back towards equities instead of hiding in bonds or cash. With the recession risk down and volatility contained, managers have more room to lean risk on. Number 6, relative value versus bonds and cash. During peak rate years, money markets and treasuries offered safe high yields, but as policy pivots, forward returns on cash and new bonds will shrink. Institutions sitting on record cash piles risk reinvestment drag if they wait too long. By rotating into equities now, they hedge against lower yields tomorrow while positioning for upside in earnings and dividends. Number 7, corporate buybacks as a demand engine. Now, corporate themselves are adding fuel to the fire. Corporate buybacks are running at their fastest pace in more than a decade, shrinking share counts and mechanically lifting earnings per share. For institutions, this creates both confidence that the management is signaling strength and a safety net which produces steadiness by reducing the downside of liquidity gaps. It's easier to commit billions when you know that the company itself is being a consistent buyer. Number 8. Sector and size tilts reinforce momentum. This buying isn't spread evenly, this focus is clear. Mega cap tech, select financials, and defensive growth in healthcare. Large caps dominate because they offer liquidity. Now it is far easier to deploy $5 billion into Apple than into some small cap biotech. These flows then become self-reinforcing, benchmark heavyweights keep rallying, passive funds track them, and institutions underweight those names that are compelled to join in. The cycle builds on itself, concentrating momentum in a handful of leaders. Together, these 8 driving forces explain why institutions, after years of caution, are putting serious money back into US equities. It's not one single factor, but a rare alignment of macro stability, earnings resilience, structural trends, and performance pressure. For retail investors, understanding these drivers is the key to interpreting what this wave of institutional activity signals for the broader market. Now, coming to my next section, which is what does this mean for retail investors? When institutions start buying in bulk, it changes the character of the market. These players control trillions in assets, so their decisions shape both short-term momentum and long-term trends. For retail investors, the current wave of institutional inflows has 3 major implications: confidence, opportunity, and caution. The number one here being which is the confidence in the market's direction. Institutional money is often referred as the smart money. While not infallible, it reflects careful analysis and risk management. The fact that the pensions, mutual funds, and endowments are scaling back into equities signals that professional investors see the backdrop improving. Whether through lower interest rates, stronger earnings, or reduced recession risk, for retail investors, this can serve as a validation. It is easier to stay invested when you know large disciplined allocators are doing the same. The steady inflows provide a cushion against the short-term sell-offs, helping sustain market momentum. In practical terms, what it basically means is that the bull case has more weight behind than the retail enthusiasm alone. Number 2, opportunities and sectors and trends. Institutions don't buy everything, they buy selectively. Understanding where their money is flowing gives you a map of the market's strongest currents. Right now, those currents are technology, specifically AI, semiconductors, and cloud infrastructure remain the focal points of growth. Institutions are adding exposure even at high valuations, which can push leadership even further. Next is financials, where wealth management firms and alternative asset managers are drawing inflows, reflecting confidence in private markets and fee-based business models. And the last one is healthcare, like I mentioned, which is a defensive growth story. Steady cash flows and attractive valuations have turned healthcare into an institutional favorite. For retail investors, aligning with these themes can provide tailwinds, but it's also worth watching for rotations. When institutions move from crowded trades like mega cap tech into under-owned sectors, those shifts can unlock new opportunities. Number 3, the risk of crowded markets. Institutional buying can fuel rallies, but it also concentrates risk. When large players all cluster into the same trades, any negative shock, disappointing earnings, or stickler inflation or geopolitical risk can trigger sharp reversals. Retail investors who chase hot sectors too late may end up exposed to the downside. This is why diversification matters. Institutions may be overweighing tech and large caps now, but they still balance it with healthcare, consumer staples, or bonds. Retail investors should take the same approach. Participate in the strongest trends, but hedge with defensive assets or quality dividend stocks. The scenario going forward for individuals trying to position alongside institutional flows, it helps to consider possible outcomes. First, obviously being the bull case, the Fed cut rates, earnings hold up, and economic growth continues. Institutional inflows will accelerate, pushing indexes to new highs. Retail investors benefit by staying invested and gradually adding exposure, especially to growth sectors. The second one, which is the bear or the cool case, inflation flares or growth disappoints, institutions reverse course, leading to selling pressure and a correction. Retail investors with balanced portfolios ride out the storm because while opportunists may find attractive entry points. The third case is the rotation case, where markets turn sideways but leadership shifts. Institutions rotate from tech into industrials, energy, or international markets. Retail investors who watch fund flows and adapt early capture these moves. Now, the practical takeaway is to ultimately stay invested. Don't let fear or volatility push you into cash. Institutions are scaling in precisely to avoid missing upside. Retail investors can mirror this discipline. Follow the flow, not the noise. Pay attention to fund flow data, sector performance, and institutional surveys. They provide clues about where capital is moving. And one thing that you have to do is diversify with purpose. Use institutional buying trends as a guide, but don't copy it blindly. Balance growth exposure with defensives to protect against sharp reversals. So this was it, guys. The aim of this video was to make you understand that whenever certain institutional buying happens, why is it happening? And maybe you're being told another story, but the data is telling a complete story altogether. So to watch more such insightful videos, subscribe to the channel and we'll keep bringing you more such content.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.